Solo 401k is the vehicle most self-employed coaches should start with. And the reason is not that it's the easiest one to set up. It isn't. The reason is the contribution ceiling. No other self-employed vehicle lets you put as much money in per year, and no other one gives you as many structural options once you're in. This unit walks the eligibility gate, the two-layer contribution structure, the 2026 numbers, and the two secure 2.0 provisions you need to know about. The trade-off is real. Solo 401k has a plan document. Solo 401k has S-corp wrinkles on payroll-driven deferrals. Solo 401k has the 2027 mandatory Roth catch-up rule for higher earners. A SEP IRA, covered in the next unit, has none of that complexity. The reason most eligible coaches still pick the Solo 401k is the ceiling math. Once your income gets above roughly $122,000 of net SE, the Solo 401k's employee deferral pulls ahead, and the simplicity premium of the SEP stops being worth what it costs in contribution capacity. Eligibility is binary. Self-employment income plus no W-2 employees other than your spouse. Hire a W-2 employee, not a contractor, an actual W-2 employee with a paycheck and withholding, and the Solo 401k closes. You'd convert to a regular 401k plan, which has very different administrative weight. The spouse exception is real and useful. A W-2 spouse working in the business can also participate, which doubles the household ceiling. If hiring is on your plan for the next 12 months, that affects whether you open this vehicle now. Two stacked layers, same person playing both roles. Layer 1, the employee deferral. You, acting as employee of your own business, defer up to $24,500 from compensation. Layer 2, the employer profit-sharing contribution. You, acting as employer of your own business, contribute up to 25% of compensation on top of that. The power of the Solo 401k is the stacking. Neither layer alone is unusual. Both layers together give you contribution capacity no other self-employed vehicle reaches. Here are the 2026 numbers. Employee deferral $24,500. Combined annual limit under age 50, $72,000. Combined with standard catch-up at ages 50, 59, and 64 plus, $80,000. Combined with the secure 2.0 super catch-up at ages 60, 63, $83,250. Compensation cap for the employer contribution math, $360,000. One caveat. For sole proprietors, the 25% employer rate is computed against adjusted net SE earnings, net profit minus the deductible half of SE tax. So the effective rate works out to roughly 20% of net profit, not 25%. IRS Publication 560, Worksheet 1 computes the precise number. The super catch-up at ages 60-63 deserves a moment because it's specifically designed for coaches who came to the profession late. $11,250 in catch-up contribution at those 4 ages, instead of the standard $8,000. That's an extra $3,250 a year, 4 years running, of pre-tax shelter for someone who's compressing their saving runway. If you left a corporate role at 55 and started coaching, you're going to hit 60 with less retirement runway than your W-2 peers. This provision is what closes some of that gap. The 2027 Roth catch-up rule lands here. Secure 2.0 final regulations apply to plan years beginning after December 31st, 2026. Participants age 50 plus with prior year FICA wages above $150,000 must make catch-up contributions as Roth, not pre-tax. Sole proprietors with no FICA wages aren't subject. S-corp coaches paying themselves W-2 wages above the threshold need to confirm before 2027 that their plan documents offer a Roth option. Many older plans don't. Module 11 covered the S-corp election. The cross-reference is the payroll-driven deferral timing that flows from it. Hold the boundary here before the unit ends. Everything I just walked, eligibility gate, 2-layer structure, 2026 ceiling, super catch-up, mandatory Roth catch-up, is the container. What you put inside that container is allocation. Stocks, bonds, target date funds, individual holdings, the percentage split between equity and fixed income, the rebalancing cadence, none of that is in this module. Allocation belongs to your fiduciary, and Unit 13.10 is where I'll route you there with a question source sheet in hand. 2 questions to close on. First, do you have any W-2 employees other than a spouse? If yes, the solo 401k is off the table and the next unit on SEP IRA is where you go. If no, you're eligible. Second, is your solo 401k actually open? If not, mark December 31 as the plan existence deadline for the current tax year. That's the most missed deadline in the whole module, and Unit 13.7 covers it in detail. Provider selection between Fidelity, Schwab, Vanguard, and the solo 401k specialist like Carrie is in Module 19.